Hey everyone, it's Tim Talks Finance, and today I'm going to share with you some of the secrets to getting a home loan. Now, in the real estate market that we're currently in, it's predicted to crash by a lot of people. So it's a huge opportunity for those who don't own a home yet, also for investors. But today we're primarily going to talk about a home loan for people who want to occupy the home or just live in the home, okay? Just the most basic of home loans. Now, personally, I've been in the mortgage industry for 15 years, and I have seen it all. But today, I'm going to break down the basics of what the banks are looking for in order to improve you for a home loan in 4 easy steps. And if you stay all the way till the end of this video, I'll show you a spot on the web that you can find any of these guidelines that we talked about today, where they're updated, and right where you can find them. So let's get into it. All right, step 1. Capacity to pay back the loan. Okay, now lenders are looking at your income, your employment history, savings, monthly debt obligations, and other financial obligations to make sure you have the means to comfortably take on a mortgage. Now, one way that lenders verify your income is by reviewing either your tax returns or your W-2s or both, pay stubs. They also get verifications of these things. They also have to determine, are you salaried, self-employed, commission? How long have you been receiving the income? Is it stable and effective? How long is it continuing for? How long is it expected to continue in? Generally, they're going to want to see 36 months after closing. Lenders also look at reoccurring monthly debt obligations like credit card payments, car loans, student loans, personal loans, child support, alimony, any other debt obligations that you have that you're required to pay monthly that aren't utilities. Like they're not going to look at your phone and things like that. Step 2, capital. Lenders consider the readily available money that you have, plus any savings, investments, properties, and other assets that you could turn into cash fairly quickly. Having money saved for investments so that you can convert to cash, known as cash reserves, proves that you can manage your finances, have funds in addition to your income, and pay the mortgage. Cash reserves might include things like savings, money market funds, other cash investments that can be converted to cash like IRAs, CDs, stocks, bonds, 401ks. Okay, along with cash reserves, there's other acceptable sources of capital. They might include things like gifts from a family member, down payment or closing cost assistance programs, grants or matching fund programs, and then my favorite of them all, one that nobody really talks about, is sweat equity. What is sweat equity? This is just a freebie since you guys have made it this far into the video. Sweat equity is when the builder allows you to participate in the building of the home in exchange for the down payment. So how does that work? Let's say it's something that like a paint job. The builder would price out how much he's going to pay the painter to paint, and then he's going to have to pay you the equivalent to go in and do your own job on your own house. Hey, I love this idea. You're saving money and you're also helping build your own home. And that goes towards your down payment. So sweat equity is a big one no one really talks about. All right, so when you apply for a mortgage, the lender may need to verify any large deposits in your bank account. Make sure that they're an allowable source. That is, that they're obtained legally. Money's not loaned to you either. Lenders may also look at 2 months of your bank statements for checking account, savings, money market, investments, just to evaluate your capital and make sure that you have it for during, before, and after closing. All right, step number 3, collateral. Okay, so lenders are going to consider the property and other possessions that you're pledging as security against the loan, okay? In the case of a mortgage, the collateral you're buying is the home. And if you don't pay your mortgage, the mortgage company is going to repossess your home, otherwise known as a foreclosure. To determine the fair market value of the home that you're buying, we're going to order an appraisal, okay? And what they're going to do is the appraiser is going to go out and just compare the property that you're buying with similar homes in the neighborhood, so that if you do default and the lender has to go and repossess that home, they know that they can sell it and recoup most of their money, if not all. They'd like to recoup all. All right, now step number 4, credit. Lenders check your credit score, your credit history to assess your record paying bills and other debts. Make sure that they're on time. Many mortgage companies also have minimum FICO score requirements. In addition to credit score requirements, if you have lower FICO scores, you may pay additional closing costs or down payments, okay? Now, even if you're a renter or don't plan to buy right now, it's a really smart idea to look at your credit and know ways to maintain your credit for good, strong credit health. Knowing about your credit scores and how to improve them, what you can do is you can watch this video right up here. All right, well, anyway, thanks for staying all the way till the end, and we'll see you next time, folks. If you like this video, consider sharing, liking, subscribing, and hit that little notification bell, and we'll see you next time.